So let's now look at the 5 or 6 things that a particular policy must contain. It is based upon regulations and it is based upon the risk appetite of the organization. So what should be the key elements of a credit policy? What makes a good credit policy? I think essentially there are 3 components, and let's take a look at them. The first is to determine what is the segment or the profile of the customers to whom you as a lending institution want to give a loan. Do you want to target high net worth individuals? Do you want to target the affordable segment? Do you want to target the microfinance customers? Now that's a philosophy and that's the appetite of the organization, which then is reflected into the credit policy. The second is to set the payment terms. What interest rate to give the person, what term or number of years to give for repaying the loan, should you take some security, should there be mortgage, should there be insurance, all that has to be spelled out in the policy. And then of course the quantum of the loan, depending upon the servicing capacity of the individual. Now these are the 3 broad principles under which you need to develop a good credit policy. As you all know, credit policies are a reflection of the appetite of the organization, the risk appetite. Now the risk appetite manifests itself in terms of its profitability, in terms of its cost of funds, in terms of its vision and mission statement, but equally important from the recovery's perspective, the behavior of the portfolio. A good portfolio or a good behaving portfolio will actually give you the additional flexibility to relax some of the credit policy norms. You might choose to or you might not choose to, but you could. Whereas if the portfolio starts having higher delinquencies, you might have to change your credit policy to tighten the norms so that the leakages that have happened through bad payments doesn't continue in the next set of loans that you bring into the system. So before we look at the risk and the appetite of the organization, let's quickly cover the regulatory aspects. I'm going to give you 2 or 3 examples by what I mean. For example, there are RBI regulations on KYC norms. There is an RBI suggestion, it might not be a rule, but it's something that's followed by all, that you need to pull a credit bureau report. There is an RBI regulation which specifies the maximum loan to value ratio that you can give for a loan. Now these are not negotiable. This is applicable for every lending institution which is covered by the RBI rules and therefore has to be built into the policy and followed to the T. There are no deviations in this because we will talk about deviations in a while. Now having talked about this and recognized that what is a regulatory requirement needs to go into the policy, let's now look at the risk appetite and all that goes into the policy depending upon the company's own vision, mission, target group and risk. Just to make it more clear, here is an example of the current KYC requirements, which is the Know Your Customer requirements, which the regulator has prescribed. It's appearing on your screen, but please remember, this is as it is at a particular point of time. It can change, but is a good example of a regulatory policy that has to be in your credit policy, because this is not up for negotiation, discussion or change depending upon the organization that you work for. You as a borrower must also remember that the lending institution absolutely has to do all regulatory requirements. So you can't say, let's not give a KYC document. The lending institution doesn't have the flexibility to not take it. You as a borrower don't have the choice of not giving it. A credit policy must cover all the aspects of the process. So for example, the first stage in the processing of a loan application is the receipt of the application itself from the applicant. Now in this, what is the policy element that comes in? That the form has to be filled out, the documents have to be attached, the KYC documents, remember the regulatory piece, have to be submitted. There is a fee maybe that is required to be paid. Now all this should be covered in the policy as far as the receipt of the application is concerned. The second step, having received it, is to complete the review of the documents submitted. So a policy in this case could be, for example, to receive 3 years balance sheets, 3 years tax returns, 6 months salary slips, any other documents that will help in determining the credit worthiness of the individual. Also, let's not forget the KYC documents, the Know Your Customer documents. As we saw a little earlier, the Reserve Bank has specified what documents are mandatorily required to complete a KYC check. You have to submit those. And each lending policy will reflect very clearly what happens if the documents are not complete. Does the file go back? Does it move forward? Or is the customer contacted at that point? Now that has to be reflected in the policy itself so that there is no ambiguity, inconsistency or non-standardization, as we call it, across the lending institution. Don't forget, processing of loans might be happening across the country at hundreds of locations. You have to bring a discipline into the process, and the way you do it is by shackling it, and shackling is not a bad word here, shackling it through a policy. So, what documents you should receive? What happens if the documents are not complete? Is there a deviation possible not to receive the documents, but to get them later? Now, these documents that we've talked about, the balance sheet, the tax returns and all, let's not forget, are absolutely essential to process the loan application and determine the credit amount that you're going to give. So postponing this will effectively mean stalling the file. So the policy doesn't have to be so flexible that it defeats the purpose for which it is being made, which is to determine, in this case, the credit worthiness of the individual. Now, once the application has been submitted and the documents have been received, you then have to do what is called the pre-sanction work. The pre-sanction work involves a couple of things. The first one is the personal discussion. Now, please remember, the credit policy of an organization is entirely dependent upon its customer profile. So, for example, if you are a micro-housing finance company, you might lay greater emphasis on personal visit to the office or the workplace of the individual and to his residence. That is a personal discussion. The policy on that must then very clearly lay out whether the personal discussion is a free-flow discussion or there is a defined set of questions that must be asked, and then leave it open to the individual, the loan officer or the verification officer who is doing the personal discussion to explore and examine other aspects that come to his mind when he is actually at the location of the customer. The next stage of the process is to check, for example, his credit bureau report, is to dedupe the data within your system itself and on any fraud check lists that are available. That policy again has to be very clear. Not just the fact that you have to pull a credit report, but what do you do with that report? The policy must very clearly say that if the score is X, then you give a loan. If it's Y, you don't give a loan. And if it's falling between X and Y, then you do further checks and leaves it open. This is a good stage for me to emphasize that while the policy must define all these rules and the playing field, so to say, it also must have flexibility. So for example, and purely as an example, if the bureau score is 750, you might say give a loan. And if the bureau score is below 550, you might say don't give a loan. But the system must allow for some flexibility based upon other characteristics of the customer's application, which might make you reject a high score loan or approve a low score loan. That we will talk about when we talk about deviations and who can do those approvals, which also must be a policy. But the fact that a fairly tight policy must be flexible is important. If I can give you that example here, again, let's take two sports, hockey or cricket. The policy is 11 players. The policy is that 2 batsmen have to come and 1 bowler can bowl an over which has got 6 balls in it. Or in hockey, everybody is told you are the forward line, you are the mid line and you are the goalie. But depending on the situation, you can always change the batting order. Depending on the situation, your forward line can fall back or your middle line can come forward to attack. Now that flexibility is given to the captain and to the team on the ground. And similarly, here also, while you will have rules and regulations which are defined in the policy, but there has to be flexibility.